Sorry, 1 second. Got to turn on our recording here. Yes, so we're excited to see you on the call today. Many of you have emailed questions into us in advance, and we thank you so much for those. For those of you who would like to pose a question to Don live during the webinar, all you have to do is simply click on the Q&A button that appears at the bottom of the screen when you hover your mouse over the Zoom video. It should pull up a box for you to type your question in, and we will be able to respond to as many of those as possible later in the webinar. Please also note we want to be sensitive to everyone's time, and so we're targeting the call to run approximately 45 minutes. If we don't get to all of your questions during that time, we will be sure to have a member of our team reach out to you directly to follow up. Also, be aware that we are recording today's webinar, and it will be available for playback should you encounter any technical difficulties during the live call, or if you need to step away early. It will also be available should you find you want to share it with friends or family. So I think that's it. So with no further ado, I'll turn it over to Don Gould, our fearless leader, President and Chief Investment Officer. Take it away, Don.
Thanks very much, Scott. And thank you all for being here this afternoon or early evening, depending on where you're sitting. We're really happy to be able to provide this service today. You know how most years March 31 rolls around and you say, my gosh, New Year's Eve seems like it was yesterday. I don't hear anyone saying that right now. In fact, Valentine's Day seems almost an eternity ago, the way time has elongated. It's just remarkable how much has happened and how quickly it's happened over the past several weeks. And obviously the news continues at a very rapid pace, both in the real world and in the financial markets, which will be our focus today. But still, it's the end of the quarter. We're 5 to 6 weeks into this unusual period of financial market turbulence. And we thought it would be a good time to take stock of where we are and where we might be going. Before we talk about money matters, just a word to acknowledge that this has certainly been a time of elevated stress for everyone. If the markets have been volatile, our lives have been even more so. And so on behalf of the whole team at Gould Asset Management, I hope that you and your families are safe and healthy and remain so. I'm going to start my comments by cutting to the end, cutting to the chase, they might say in Hollywood. And that is this too shall pass. The economy will recover, markets will recover. Of that, I am extremely confident. The larger questions are how and when, and I'll be talking more about that in a little bit. So I want to start with the economic backdrop. Whenever somebody comes to me and says, I've got some good news and some bad news, I always say, well, give me the bad news first. Let's get that out of the way. And so that's where I'm going to start. And it's not really news at this point, because if you read the newspaper, you know what's going on in the economy, but I think it's important to review it for some context. So first of all, what's happened? Well, 8-9 weeks ago, we entered February with a generally healthy economy in its 11th year of expansion at 50-year lows for unemployment. And 6 weeks later, by mid-March, the entire people-facing part of the economy was shuttered. Restaurants, hotels, malls, airlines, house cleaners, theme park workers, golf instructors, the list goes on. And suddenly, millions are newly unemployed, and for an indeterminate period of time. What's uniquely challenging about this downturn are at least a couple things. And the first is who's unemployed. We like to think of our massive economy as a juggernaut, and usually that's how it behaves. But that masks some vulnerabilities that I think have been exposed by this crisis. A huge percentage of American workers have no savings. I'm sure many of you have seen the headline that 40% of American households could not come up with $400 in cash in an emergency. So who are these workers? Well, first of all, they're the lowest paid segment of the workforce generally. They're living paycheck to paycheck. They're typically service workers. And here's the important point. They are exactly the people who are now out of work. If you think about our economy and you think about the interdependence of our economy, each player's financial and economic health is to a large degree dependent on the financial and economic health of everybody else in the system. It's a little bit like a daisy chain. So just to take one simple example of this interdependency, consider the case of a service worker who's been laid off as a result of this crisis, who's renting an apartment. Suddenly that person's out of work. They perhaps can't pay their monthly rent to the landlord because they have been living paycheck to paycheck. Ultimately, the landlord is going to have difficulty making payments to the bank on the mortgage or making payments to the state government for property taxes. And eventually the bank and the state government are facing problems. And so you can see how even though we start with a small household with not a lot of savings and not a lot of economic power, collectively, if those households have problems, economically, we have a problem throughout the economy. The second point that I think makes this a uniquely challenging situation is that there are limits to stimulus when there is little to stimulate. What do I mean by that? Well, in a typical economic slowdown, fiscal stimulus works. And what do we mean by fiscal stimulus? We mean tax cuts, we mean government spending, or some combination of the two. In this contraction, not only has demand fallen because so many people are suddenly out of work, but simultaneously, what's also fallen is the opportunity for consumption. The primary places that one can spend money at the moment, given the lockdown, are on either rent or mortgage and groceries. Fully 70% of our GDP is consumer spending, but even those who have money in this environment have far fewer opportunities to spend it. So I think these are two things that we have to keep in mind when we look at how this downturn is different than others we've seen before. The upshot of all this, and to conclude the bad news part of this presentation, is that for some period of time, we're going to be looking at unemployment and GDP numbers that are really startling. They're going to be different from numbers we've ever seen before. They're going to be different in their size and in their suddenness. We hope that they are of very short duration. Time will tell. Okay, now let's move to some better news. First thing I would point out is that although the most visible parts of the economy, what we might call Main Street, the retailers, are the part of the economy that has been hit the most and that is most shut down, there are major but less visible parts of the economy that are still functioning quite well. We start with what broadly might be called the knowledge economy: software developers, graphic artists, accountants, financial analysts. All of these groups are still very hard at work, probably harder at work than they were before the crisis began. Healthcare obviously is an area in huge demand right now and under great duress, but certainly in huge demand. The utilities, of course, are operating as usual. Governments are operating as usual, and governments are huge employers both at a federal and state and local level. Second piece of good news is that the public health response, albeit belated, has been quite positive. Governors, mayors, and others have acted quickly and decisively to order the social distancing, or what we now simply call the lockdowns. And I'm convinced the lockdowns are working. It's true that if you drive down into your local town, it looks a bit like a ghost town. But the good news is that the very fact that it looks like a ghost town means we're slowing the rate of transmission of the virus. Based on everything we've read, it would appear that the rate of new cases is expected to peak sometime in April, depending on what part of the country, depending on when the lockdowns were initially put in place. That's obviously good news. So the curves that we've all seen are being flattened, and I believe we have a chance to come out of this dramatically better than the worst case scenarios that we've all read about. Third piece of good news is that I believe the government's economic response has been very good. I give the government good marks so far, both on substance and speed of action on the economic front. We've seen a rapid introduction of both fiscal and monetary policy that together, if I can use the analogy, are like a ventilator for the economy. The economy is having some trouble breathing, but these government fiscal and monetary policies are tremendously effective at helping the economy get through this crisis. On the fiscal side, we've heard about the CARES Act, which is an acronym, which provides substantial financial relief, approximately $2 trillion, which equates to about 10% of our annual GDP. So it is by far the largest fiscal intervention in the history of the country. The CARES Act is going to help businesses stay afloat, and it's going to help them keep employees on the payroll, even in the absence of revenues. And this is true from the smallest Main Street restaurant business to even very large corporations, like airlines as an example. In turn, this should help the economy restart more quickly when we get to the other side of this crisis. A third aspect of the CARES Act is it will be sending payments directly to individual households, and that's going to help with meeting those payments for rent and groceries. And finally, the CARES Act is hundreds of pages long, and there is not a corner of the economy that is not in some way aided by this piece of legislation. The second part of the government economic response that has been critically important and very, very positive has been on the monetary side. And here we believe the Federal Reserve has really done its job. The Fed has stepped in to support credit markets by being a lender and a buyer of last resort. A couple weeks ago, we saw a not unpredictable rush to cash by businesses and individuals who were trying to insulate themselves against uncertain times ahead. And the Fed stepped in and provided liquidity and basically has supported the credit markets throughout. And that includes financial institutions helping them meet the liquidity demands of their customers. And it's also involved direct intervention in the bond markets. The bond markets aren't as spectacular, shall we say, as stock markets, but the bond markets are almost like the foundation of the overall financial system. And the Fed's done a great job of keeping those markets functioning and orderly. Another area where we see a lot of positive things developing is on the scientific and industry response to the virus. Treatments are being tested, which could reduce the severity of the illness. Vaccines are being developed. Johnson & Johnson has said they will be testing vaccines as early as September. Antibody tests are being developed, which would help us identify those who already have immunity to the virus. And belatedly, ventilators and masks and other supplies, critical medical supplies, are being manufactured. The great unanswered question in all of this is, how long must this lockdown last? If we could answer that question, we would know how soon the economy can begin to restart itself. Now, paradoxically, the flatter the curve, the more we flatten the curve, the more we widen the curve. And the wider the curve, potentially the longer the lockdown that's necessary in order to keep cases from spiking again. But it's not purely an either-or situation. It is possible to flatten the curve without unduly elongating the lockdown period. But to do that will require a great deal of leadership, creativity, finesse, and a huge high level of societal cooperation. So those are the things we have to be watching for. Okay, I want to now turn to the markets. The stock market, of course, has been extremely volatile since mid-February. We've had a period of sustained volatility unlike any we have ever seen. And yet, I would argue that the stock market has behaved pretty rationally throughout the crisis. The S&P 500 is an index we like to use as a benchmark for talking about how the stock market has performed. It represents most of the US market capitalization and a big portion of the world market capitalization. And the S&P 500 is down about 1/3 from its mid-February all-time peak. Roughly speaking, we think there's three components that explain the drop. The first is probably the most obvious, and that's corporate earnings. Corporate earnings clearly are going to be depressed for some period of time. If you think of the price of a stock, the price of a stock is the present value of all of its future corporate earnings distributions from now till eternity. So when you slash those corporate earnings in the short run, clearly you have reduced to some degree the value of the stock. And so that's the first component of the drop in stock prices. Second component is that uncertainty is way up. We don't know how long earnings will be depressed. We don't know how quickly the economy will recover once the coast is clear. And so part of the markdown in stock prices also reflects that there's more uncertainty when we look to the future than is normally the case. And I think the third component to the stock decline is what I might call a liquidity rush, a rush to cash that really seemed to peak about 2 weeks ago. We saw indiscriminate selling of virtually any asset that could be liquidated. Stocks, bonds, gold, even treasuries were undergoing mass selling, and we saw the yields on treasury bonds fluctuate quite dramatically. The stocks have regained about 1/3 of their total decline from the low that we saw a couple weeks ago. And I think to a large degree, that's a recovery of that third point, that liquidity rush. That liquidity rush pushed us down a leg, and I think we've recovered that leg. And that's in large part because the Fed, the intervention I've talked about with the Federal Reserve, also the fiscal stimulus, the CARES Act, I think has been very well received by markets. Moving on to bonds. Bonds had a few scary days a couple weeks ago. Prices on even highly rated corporate and municipal bonds fell sharply for a period of time, but thankfully with help from the Fed, prices have substantially recovered and order seems to have been restored. Interest rates on bonds are really a tale of two cities. If you look at the highest quality bonds, specifically treasuries, yields on those have gone down significantly since mid-February. The 10-year treasury was yielding about 1.6% in mid-February. Currently, it's yielding about 0.7%. Treasury bills, their yields have gone pretty much to zero from over 1% at the beginning of the crisis. But if you look at riskier bonds, their interest rate's gone way up. So the spread between high quality bonds and lower quality bonds has really blown out quite dramatically. Just to give you an example, a high yield corporate bond, meaning a bond of an issuer that in general is somewhat riskier than the higher quality credits, might have been around 4.5% in mid-February. Today, it could easily be over 13%. And that reflects the higher risk of default when the economy slows. Real estate has not been immune from any of these problems. And if you think about it, we could probably guess that retail real estate has taken the worst hit because when stores and restaurants close overnight, you can expect that they're going to have almost immediate difficulty paying rent. Commercial, industrial, and apartments probably faring better because hopefully only a relatively small portion of their tenants will be unable to make their rent payments in the near future. But in any case, I think although we can't see the price of real estate moment by moment, it's reasonable to think that real estate prices have fallen much in the same way that the stock market has fallen. Okay, now I'm going to return to my original point, and this is our thesis. And that thesis, again, is that this too shall pass. There's much we don't know right now. We don't know how long the lockdown will last, and we don't know how quickly the economy will recover after the lockdown ends. But there is much we do know. We do know that the virus will eventually run its course. We do know that the lockdown will end at some point. We know that the economy's basic infrastructure is entirely intact. And if you want to prove this to yourself, get in your car and just drive into town. And what you will see is that the roads and the bridges and the buildings and the storm channel drains and everything else, or drive by the airport and you'll see even if the planes are idled, they're there. They're ready to be fired up again. So the basic infrastructure of the economy is completely intact. This is not like a war situation. And finally, what we know is that people will emerge from this crisis with the same needs and wants that they had before the crisis. And given all of this, we can confidently say the economy will recover in time. And as the economy recovers in time, corporate earnings will recover. And as corporate earnings recover, stock prices will recover. And undoubtedly, at some point, will reach new highs. We're fond of saying that asset allocation is the key to a successful long-term investment strategy. We know that stocks reward people greatly in the long term. I recently calculated that over the last 93 years, the US stock market is up 640,000%, which I can't even get my arms around that number, but it's a big number. We also know that over shorter time periods, stocks can be downright terrifying. And so the trick is to balance those two realities. The right asset allocation is the one that balances those. And as a rule of thumb, we tell our clients, be prepared at any time for a 50% decline in your stock portfolio. Now, that's an extreme case. Right now, we're down about 25%, but we've seen 50% declines twice in the last 20 years alone. Your portfolio, you should be able to withstand that kind of decline without abandoning ship. That is, without abandoning this strategy. And if you can't, then maybe you have more in stocks than you ought to. But we're quite confident that as a general rule, our clients' asset allocations are about where they ought to be. And the reason we say that is because our measurement or our evaluation of client risk tolerance was done in times of, how shall I put it, in calmer times. It's very difficult to measure one's risk tolerance when you're in a heightened state of fear. And so this happens to be one of those times where it's hard to really evaluate your risk tolerance, and it's better to look back at how you looked at your risk tolerance in a calmer period. Okay, just a couple things before we get to the Q&A. We'll say it again, market timing is dangerous. We never know with certainty where stocks are going next. But even if you did know with certainty that stocks were about to go down, it would still not be enough to warrant selling. And you might ask, how can that be so if we know that stocks are about to go down? And the answer is because the assumption when you sell is that you will buy back at a lower price than you sold. Because if you can't buy back at a lower price, then why sell in the first place? In other words, knowing when to sell is not enough by itself. You also have to know when to buy back. And in our experience, those who sell in times of fear almost never buy back until they feel much less fear. And guess what? By the time we're not feeling much fear, markets usually are at or above the levels at which we sold. Okay, one final point. And we wrote this in one of our letters recently, but a way that might help you psychologically through this period, at least with respect to your portfolio, is to remember this. Stock investments are not casino wagers. They are investments in real businesses with long-term futures ahead of them. If you have your own small business, you own stock in that business, but you don't think of the stock the way you might think of stocks on the stock exchange. You think of it as a livelihood and as a long-term project. But in fact, that's what stocks are. They're investments in long-term businesses. The curse of stocks is their liquidity. Because our smartphones tell us the changes in price from moment to moment. And as they do, we start thinking more short-term instead of long-term. In my ideal world, the perfect stock investment would be one that's encased in a locked black box where you could only open it up once every 10 years to take a glance at the price. Because if that were the case, I think people would look at their stock portfolios more the way they look at real estate investments, which is to say the current price is not that important. I'm not planning to sell my piece of real estate today. I'm holding it for the long term. I'm under no pressure or compulsion to sell it at depressed levels. Tenants are always going to need a place to live and to work. And I think if you can apply that attitude to your stock portfolio, you'll find that periods like this are a lot easier to endure. Okay, now we're going to move to the Q&A, and I will turn it back over to Scott.
Perfect. Thank you, Don, for those insightful comments. We're going to now, move over to the Q&A section. Just a reminder, if you'd like to submit a question to Don, all you need to do is hover over the video and click on the little Q&A button. A box should pop up, which will allow you to type in a question. I already see a handful of questions that people have typed in, so thank you. We'll go ahead, though, while we let people think about their questions and type those in, we'll go ahead and start with some of the questions that we received via email in advance. So Don, the first question is, where does the market go from here in the near term?
I don't know. But if you're a long-term investor and you accept our long-term thesis that this too shall pass, where the market goes next is just not as important as it may feel at the moment. However, since you asked, the answer is it depends. It depends on how the future diverges from what is now expected. So for example, if the lockdown lasts longer than expected, the market might have further to fall. The converse is also true. How long is this lockdown going to last? It depends on a lot of unknowns. It depends on advances in the healthcare front, treatments, vaccines, tracking, monitoring. It's going to depend on consumers' willingness to spend after going through this trauma. It's going to depend on whether government can continue to act in an enlightened way. I would say be prepared for more declines. That doesn't mean they're going to happen, but be prepared for them. Be prepared for more volatility. For a short-term trader, that's important, but for a long-term investor, remind yourself that that is mostly noise.
Okay, great. Next question comes to us from a client. They ask, as you assess the market, do you see potential political or economic risks from a delayed, postponed, contested, or compromised presidential election in November?
Well, we never say never. We know that anything is possible, but we don't see that as a likely scenario. I think a more likely scenario is that we may go to an all mail-in election. And frankly, that gives me some reassurance after seeing the debacle in Iowa. I think paper ballots mailed in by the U.S. Postal Service probably gives us a better chance of a non-controversial outcome in November.
Great. Next question is on real estate. How will the real estate market respond to this current economic environment?
I think I would just refer back to the comments I made a few minutes ago. That, clearly this is a challenging time for real estate because real estate depends on tenants and specifically on tenants making their rent payments. And when tenants can't make their rent payments, then obviously the economics of real estate are challenged. But I would expect real estate to recover completely in lockstep with the rest of the economy.
All right. Next, how long will it take for the economy to rebound? And do you think it will be V-shaped or U-shaped?
It's too soon to tell, of course, for all the reasons that we've talked about today. But I will say this, I think the sooner a recovery begins, the more likely it is to be a V-shaped recovery. And by V-shaped, what we mean is sort of a sharp down, but an equally sharp up recovery. And the reason I would say that is because I think the shorter this lockdown lasts, the easier it is for businesses to pick up where they left off. And I think that's the whole idea behind the CARES Act. On the other hand, if it takes longer for the rebound to start, it's going to be harder for businesses to simply pick up where they left off. And that might make for more of this sharp down and then a more elongated bottom, or what they call the U-shaped recovery. Having said that, I do think modern technology makes it likely that we will be able to restart those parts of the economy that are currently shuttered much more quickly than might have been the case, say, 30 years ago.
All right, next question has to do with cash. What are my options for money I want to keep in cash right now?
The absolute safest and most liquid option for cash right now is one of two things: U.S. Treasury money market funds and FDIC insured bank savings accounts. By default, all of our clients' idle cash sweeps into one or both of these options. Because of the very strong preference for safety and liquidity right now, the yields on both of these are quickly heading back to zero. You'll recall after the crisis of 08-09 that interest rates went down on money funds and on bank accounts to 0.01%. And in the case of the major money center banks, they never went back up. But most of the rest of the cash options did go back up to the 1% to 2% range. So there are some alternatives to these. Online banks, for example, like Ally and Synchrony, are still offering between 1.5% and 1.75% on FDIC insured balances with daily liquidity. Of course, those are subject to change at any time. Other high yielding options would include tax-free money market funds. Many of them are currently paying over 2%, but those yields are dropping rapidly as order in the municipal bond market is restored. One interesting option is 3-month brokered CDs, which we're able to purchase through brokerage firm marketplaces. These are also FDIC insured and are paying between, say, 0.75% and 1%. They're not as liquid as the other options I've discussed, but they do lock in that rate for, say, 3 months as an example.
Okay, great. We've got a couple more questions that were emailed in advance. Next one touches on the CARES Act. We heard that we could delay the RMD for 1 year. Does that mean we would have to take 2 the following year?
Okay. Yeah, the CARES Act permits people who have IRAs who are already taking required minimum distributions. Those are the distributions you have to take historically when you reached age 70 and a half, and going forward when you reach age 72. The CARES Act allows you to skip your 2020 RMD, and you do not need to make it up next year. It's just a one-time pass on the RMD. If you're in a moderate to high tax bracket and you have after-tax assets that you can draw on for living expenses, you should seriously consider skipping the RMD, because it could save you a lot of taxes permanently. If you've already taken your 2020 RMD, as far as we know, you can't reverse that, but it is possible that there will be amending legislation that would permit that.
Okay, great. And then last question before we hop over to those coming in live. It's a question about real estate again. It says, any advice on how to think about selling homes? I was planning to sell my house in June or July, and I'm wondering if I should just get it on the market ASAP.
Well, first, we're not realtors, and it's obviously a question you should pose to a realtor, one who knows your local market. Common sense would say that it could be difficult to sell a house in this environment. You can't have an open house. People have an awful lot of other things on their mind right now. On the other hand, if you are patient and you can wait for your price, there may not be a big penalty for trying. Although, again, realtors I know tell me that having a house on the market for too long sometimes can hurt the price that you're going to get on it. So I talked to a realtor, but common sense says to me, probably not the best time to put something on the market if you don't have to.
Great. Okay. So Don, now if you open up the Q&A box, I see a number of questions there. I don't know if we'll be able to get to all of them, but if you want to pick some of those to respond to.
Yeah. So here's a question. It says, someone who has just started retirement, what do you say to them? Should one move to cash and look for calmer times to reinvest in the market? My answer there is unequivocally no, you should not. Because again, you move to cash, you're earning zero, but the really hard part is nobody's going to ring a bell telling you when it's time to get in. In all likelihood, you'll be getting back in at levels above where we are today. That said, certainly as we go through the life cycle, it's normal for the stock bond mix to become more conservative with age. If we think of human capital as an asset that represents the present value of our future earnings stream from work, and now we're retired, that part of our portfolio arguably has gone to zero, which means that what we're left with is our financial assets, and therefore we may have to get somewhat more conservative in that allocation. So that's my answer to that question. Let's see. If you have been taking out monthly distributions, would you continue in a downturn market to do so? If you're taking the monthly distributions because you need them to live on, then the answer is yes, I would continue to take them out. Again, we don't know where we are relative to the bottom of this particular bear market. You know, I think the point is that you're taking out a very small amount each month, and you're planning to take it out over a very long period of time. And whether you happen to take it out at the bottom or partway down, or even at a temporary top, it really is not going to make a big difference in the long run. So I would probably stick to what you're doing. If you don't need the distributions, then I suppose the question is why take them in the first place? But if you don't need them, sure, leaving them in could be helpful long run. What happens to the economy if there is a second spike and we must have another lockdown in 6 to 8 months? I think obviously it wouldn't be good. You would, again, you'd have the people facing part of the economy having real problems. I think, as I said, the key here is to find a sustainable path that allows us to emerge from the lockdown without having to swing back and forth, between periodic spikes. But clearly that wouldn't be good news. Question, are you concerned about the effects of ongoing and emergency federal deficit spending? I think that's a great question. It's a question that has raged certainly for the entirety of my career. I remember in the late 80s reading books that said that, the growing federal deficit was going to be the end of our economy. I remember Ross Perot running for president with his famous hockey stick chart showing the exponential growth of the federal deficit. Here we are, 25 years later, economy's still chugging along. It's just really not clear whether these deficits, or at least to what degree these deficits retard economic growth. Certainly it is the case that if interest rates were to go up significantly, the amount of interest that the government would have to be paying on the larger debt would go up and would become a more meaningful part of the federal budget. But honestly, I've given up trying to answer that question because after 35 years, I haven't found an answer. Let's see. Okay, here's a question. What implications do you foresee from the separately unfolding collapse in the oil markets? That's something I didn't get to talk about, but that was on top of everything else that was happening 3 weeks ago. We had a breakdown in the OPEC-like negotiations, particularly as between the Saudis and the Russians, as to whether they would restrict their oil production in order to keep oil prices higher. Obviously, oil prices have been under tremendous pressure because the economy has turned down. I've seen estimates that say that at the moment, our oil consumption is down 25%, which is a massive number. And this has been another shock on top of everything else because although oil stocks are a much smaller part of the stock market than they used to be, probably less than a third of what they were relative to the whole market 15 years ago. The energy industry is still a very big employer, and it's a very big source of capital investment in our economy. So there's no question that that is going to be a drag on economic activity. On the other hand, of course, for oil consumers, again, when we have a reason to consume more oil, whether that's flying or driving, lower oil prices are going to be an economic stimulant. Let's see. Okay, do you have any sense of what percentage of the reduction in demand will rebound once the, quote, fever breaks, and what percentage will be permanently lost? I suppose my guess is as good as yours. As I said earlier, I think when we get out of this crisis, people will still have the same needs and wants that they had before. There are some things that have been deferred. An obvious example here would be a vacation. that I would think could be recaptured in economic activity on an upturn. There are other things like a restaurant meal that will never be recaptured. Those are permanent losses. But that is what it is. Let me see if we have any more questions here.
Don, I see one here. How is this crisis different from the 2008, 2009 great financial crisis?
The 2008, 2009 crisis was focused on the financial side of the economy. So, people talk about Main Street and Wall Street. The economists call it the real economy and the financial economy. 2008-09 was really focused on a breakdown in the structure of the financial economy, which threatened to bleed into the Main Street real economy. Here, it's really in reverse. The problem has started in the real economy and has bled into the financial economy. But as I said, thankfully, I think the Federal Reserve in particular has done a great job in shoring up the financial side. Washington is trying to shore up the Main Street side with things like the CARES Act. But I would say that's the principal difference. Well, I see we are approaching our ending time here. I wanted just to mention in closing two things. One, this is our first webinar. We would love to hear what you thought of it. It won't be our last. Like everyone else, we have come down the learning curve with Zoom and other video technologies in the last few weeks. So plan on seeing more of these. And I also wanted to mention that we just introduced an updated version of our new website, www.gouldasset.com. So please take a look at your convenience. Again, thank you very much for your time and attention today, and we wish you all the best.
Thanks, everyone.